Starting to invest might seem complicated, but it isn't. However, there are some things which are critical to understand before you get started. Now, the best place to start is understanding why investing is so important. Ultimately, it's due to the value of money going down over time. The cause of this is inflation. Inflation is when the price of goods and services goes up or is inflated over time. The Bank of England has a target for inflation. Typically, this is between 2 to 2.5%. Now, it's a fair bit higher at the moment at 3.1%, and it's probably going to rise to somewhere around about 5%, resulting in all the money you have being able to buy you less stuff, meaning the value has gone down. Hence the reason why in 1971 a pint of beer was 16p, and now it costs you at least north of £3. This is the impact of inflation over the long term. Now, lots of things factor into inflation, such as how much money is printed and supply chain issues, along with a raft of other things. But the impact which inflation has is important, and this is often known as the time value of money. The time value of money concept, which describes that money today is worth more to you than it is in the future due to inflation. As inflation carries on going up, your money will continue to go down. The time value of money is an important concept to understand when it comes to deciding when you start to invest. Now, I'm going to talk about this towards the end of the video, so make sure you stay tuned for that. An example of inflation might be if you kept £100 in the bank for 5 years. To get the same purchasing power as that £100 today, you would need £115.93 in 5 years' time, assuming an inflation rate of 3%. So the challenge becomes, how do we grow the £100 to make sure it beats £115.93 in 5 years' time? Looking to savings accounts is a dead end, as most have interest rates, which is just how much the bank pays you to keep money with them, of around about 0.5%. This does not keep up with the 3% inflation rate, never mind beat it. This is where investing comes into the game. If we invested our £100, we get the benefits of compounding. If we made an average market return of 10% per year over 5 years, after year 1 we would have £110, year 2 £121, year 3 £133.10p, year 4 £146.41, finally year 5 £161.05. We have compounded our £100 by growing it each year, then having a higher base the next year. Basically, the 10% is a higher value due to the fact you have a larger starting pot each year. This is the best way to not only match inflation but to beat it. We've made a 50% return on the initial £100 because we kept it invested over 5 years. So the longer we can leave the money in, the better returns we can get. As we've seen with that example, an investment is something which grows in value over time, not going down in value like money. The simplest investment to understand is a property. Investing into stocks is similar but has some major advantages which I'll touch upon. Let's say a house is on the market for £100,000 and we buy it, slapping down a 25% deposit, meaning we have a mortgage for £75,000. So we start renting the place out to a tenant for £600 a month. Let's say you have costs of £300 per month. So the profit you make is £300 per month, meaning you would make £3,600 per year profit from this property. Stocks are the same in the way you can get a cash flow each month, quarterly or yearly. This is the first way to make money from an investment. The second way is via the value of the investment going up over time. Roughly, the house prices double every 10 years in the UK. So in theory, in 10 years time, the house will be worth £200,000. But buying into property is expensive and takes a long time. So one of the quickest and easiest ways to invest is to buy some shares in a company. So shares are just a part equity ownership of a business. So if you were to buy a share of Apple, you'd be part owner of Apple. This comes with the benefit of potentially getting a dividend. Normally, the amount of money the company will pay out will be split between all the shareholders. So the more shares you have, the more of a dividend you will get. The price you buy shares at is key as well. For example, in November 2011, the share price for Apple was £9.68 per share. So let's say you purchased 10. It would have cost you £96.80. Whereas today, Apple's share price is around about £111.82. So this means your 10 shares would be worth £1,118.20, which is fantastic growth. To buy shares, you need to use a broker. These are just middlemen who'll make the trade for you. It's sort of like going to Amazon and picking what you want to buy. You go to a stockbroker and pick which stock you want to buy, and they'll process it for you. This used to be really hard to do, where you had to call someone up to do this for you. But now with the internet, it's never been easier to do. In the UK, most of the high street banks will offer this service, where you can invest with them. Personally, I'm not a fan. I like using platforms which are solely brokers. So I personally use Vanguard, Hargreaves Lansdown, and Freetrade. So I can hear some of you sitting there saying,
Jim, how do you pick which stocks to invest into?
Well, you don't have to. There's a really easy way to invest which takes all of these decisions away from you. Investing into individual stocks is pretty risky. If all of your money was sat with one company and they underperformed or ended up going bust, you would lose it all. Not only this, but just because Tesla has gone up 500% in the past, it does not mean it's going to happen in the future. Nothing is guaranteed. Generally, also, you need to be following the performance and financial statements of these companies, which is a full-time job in itself. Thankfully, there's an easy solution for beginners, and this is how I invest myself, and that's to invest into index funds. I believe that for 95% of people out there, index fund investing will offer the safest and best returns over the long term. So there is two parts, the index and the fund part. So an index is something like the FTSE 100 in the UK or the S&P 500 in America. Now, both are indexes of the 100 and 500 biggest companies within those countries. If you look at the FTSE 100, you'll see all of the biggest companies in the UK, and they'll normally be ranked by size of the company. So at the top, you'll have household names like Shell, Unilever and Tesco. So the reason why these indexes are so useful is they will generally mirror the performance of the economy of the country as a whole. So if you look at the performance of the FTSE 100 over the long term, it will mirror the economics of the UK. We had a big dip in 2008 and during the start of 2020. Then when the index is growing, we can see the country is going through a booming period. A fund is basically where a group of people will give a fund manager their money to look after it, and this fund manager will then invest the money for them. These funds tend to be hundreds of millions of pounds, and these fund managers will get a percentage fee for looking after the fund. So they will take away all the stress from you for picking any stocks. So they could pick to invest 10% in Tesla, 10% in Google and Amazon. But the easiest way is if they track an index like the FTSE 100. So this fund will then invest the money into all of the companies within a certain index. The amount they invest into each company is normally based on the market cap of the company within the index. So basically the size. The bigger the company, the more of a holding. The smaller the company, the smaller the holding. This is the reason why for most people it's the best way to invest. You do not have to pick and choose which shares you think will perform well. You just invest into a fund, will invest into the whole market for you. They will generally give you lots of diversification, which is just making sure your investments are spread across different sectors, like energy, technology and food for example. These indexes have a massive range of companies in them. So if one is underperforming, chances are another will be performing well. Another major advantage to this is really low fees. Most of these funds are looked after by a computer. It will automatically change the amount it invests into each company based on performance. If, for example, you pay the human to do this, they might charge you a few percent for doing it. Over the course of many years, this can massively chip away from the amount of money you can make. Don't forget, we're trying to fight against inflation, so keeping fees low is a massive benefit. Finally, most individual fund managers actually struggle to beat the market. In fact, one of the most famous investors, Warren Buffett, challenged a hedge fund to a bet. He said he would beat their returns by investing into an S&P 500 index fund, then picking stocks over the course of 10 years. Over the 10-year period, Buffett beat the hedge fund managers, showing that the fees they charge were not merited when you can track the market performance and get better results. The way I like to think about it is you're just investing into the market as a whole, instead of placing one bet on one company, which to me seems higher risk. Can you lose money doing this? Well, the answer is yes, you could, but it depends on the time horizon you put on holding your stocks. Normally, it's reasonable to say you want to keep any investments for a minimum of 5 years. Your investments will go up and down, but you need to ride out these dips to give your investments time to grow. If you compare the value of the FTSE 100 from 2008 to now, it is more than double. But if during that time you had sold when the stock had carried on going down, you would have missed some of the best returns. This is why for most of us, investing into index funds is the answer, as over the long term, the trend is always going up, with an average market return of between 6 and 10% for most index funds. Whereas if it was a private company, there's a real chance you could lose everything if it went bankrupt. Now, obviously, none of the information in this video is financial advice, so make sure you do your own research before investing into anything, and make sure it works for you. We're going to go back to the point we made at the start of this video about the time value of money. So money today is worth more than it is in the future. So this means we should start investing as soon as possible, as money today will be able to buy you more shares than it will in the future. Although you should try to get started investing as soon as possible, there are 3 things you want to make sure before you do that. First off, if you have any high interest debt, normally in the form of credit cards, make sure you pay these off. Like we spoke about compounding when it comes to making money, this also happens with debt. So this will be very expensive for you if you don't pay it off. Number 2, we have making sure you have an emergency fund. I would recommend at least 6 months, if not more. This fund is sat in your bank in case you lose your job or something happens to your house. It means you have a pile of cash to burn through in order to give you time to get you back on your feet. Finally, you need to be able to set and forget any money you're going to invest. In my opinion, it needs to be a minimum of 5 years, but ideally as long as possible. So make sure it's money you will not need during this time frame. As long as these 3 things are met, everyone should be investing something into the stock market as soon as possible. The major advantage of investing into the stock market nowadays is you do not need loads of money to do it. You can research different funds on platforms and find out the minimum investment they require. This could be £100 or as low as £10. Even if you start with £10, this is the perfect place to start for 2 major reasons. Firstly, you are starting the process of compound interest, which will carry on growing and growing over the long term. Secondly, and most importantly, you're going to get into the habit of investing. Once this happens, you'll be looking at ways to get more money to invest so it can grow over the long term. To get started, I would suggest looking at a few different brokers like I mentioned before. Vanguard, Hargreaves Lansdown and Free Trade, but you can use any you want. The 2 major things you you want to look for is to make sure you can invest into index funds on the platform and make sure the fund has the lowest fees possible. Once you've signed up and confirmed everything with the broker, you'll be good to go and start investing. One of the best things to do is to set up a direct debit every single month from your account into the fund so you can just forget about these investments. At first, you'll probably want to check your investments all the time, which is normal. After a while, you just forget about it and probably check it every few months and see how much money you've made over that time. In the UK, we have things called ISAs, which are individual savings accounts. If you're going to invest and have not set up one of these, you want to set up your account on your brokerage within a stocks and shares ISA. Every year, we get a £20,000 ISA limit, which means you can pay up to £20,000 a year into these accounts. The best thing about your ISA is any of the money you make from your investments will be tax-free forever, so you will not pay a single penny in tax down the line from your investments, so you need to make sure you're using your ISA. Also, if you're aged between 18 and 39, you can set up a lifetime ISA on Hargreaves Lansdowne. This is a government scheme where you can invest up to £4,000 per year, and the government will give you an extra 25% for free, and then you can use this to invest into stocks and shares or into index funds. So if you max it out, you can get £1,000 for free before you even start investing. But you can't access this money until retirement, which is actually a good thing in my opinion, as you've got lots of time for this money to grow. And if you've got any extra money outside of this lifetime ISA, you can set up another stocks and shares ISA and use the rest of your £16,000 allowance. If you guys enjoyed this video, please consider subscribing. I'm Jim and I make videos about all things investing and personal finance, and I'll hopefully see you guys in the next one. Cheers.